Good afternoon, and welcome back to Reflections on Investing with the Cornell Capital Group. And I think we have a particularly interesting one for you today. Frequently, when investment managers talk about the role of the capital market, they stress, we should buy this company or that company, or expose ourselves to this factor and that factor and so forth. Those are all at a micro level. But how does the financial market work at a 30,000-foot level? That's what we're going to examine, and it has important implications. So let's start here with the first exhibit. This divides the economy into three groups. Savers, primarily individuals, corporations, and the government. These are organizations that want to set aside some money for future consumption and hopefully get a return on that money they set aside. At the other end are the real investors. Those are the people that take the money and invest it in things like factory equipment, vehicles, software development, agriculture, real estate development, and on and on. All real things. Those are the real things that make the economy grow. There's new investment, it produces new goods and services, and the economy grows. And part of the benefits of that growth are paid back to the financial intermediaries, who then pay it back to the savers. But the ultimate source of the wealth is the real investment by the final investors. And what financial intermediaries do is grease the wheels. It would be very difficult for Microsoft to borrow money directly from me. But the financial markets can set that up where I buy a security and Microsoft issues that security and the money goes to Microsoft. Now, in this context, the financial markets play two really important roles. One is price discovery. That is, how do we know how much a certain technology, like let's say large language models, is worth? Well, we could ask experts, but we believe in markets. So that's one thing the market does, is it indicates what investors as a whole think the technology is worth. And the other thing is capital allocation. How much capital should be allocated to different things? How much should go into AI and how much should go into cruise lines, for example? In countries like Russia, the government tries to do this, and they often do a very bad job of it. So this is the 30,000-foot view of the operation of financial markets. Savers take their cash, give it to financial intermediaries who give it to real investors, and then the return comes back from real investors to financial intermediaries and back to savers. But the ultimate source of all the wealth for savers is the real investment on the right, which allows for economic growth. Now, having said all that, we want to talk a little bit about cryptocurrencies, which have been so much in the news. And to do that, I've got a very simple example. This is a society that has just three individuals, A, B, and C. And each of them owns 5 shares of a stock that gives them the rights to the return on investment made in the society. In other words, the economic growth. And that's where we are at the start. So the total wealth of the society is 15. Perceived wealth, if you asked all the individuals to add up their wealth, would also be 15, 3 times 5. Now, A turns out to be a very creative person, and he invents something called coin. Coin doesn't have any rights to the goods and services produced by the society. It's just, as Bitcoin, it's just a mathematical invention. But nonetheless, A is able to hype up this coin and thereby sell it to B for 1 share of stock. So after all this happens, A has 6 shares, B has 4 and a coin, and C has 5. So the perceived wealth has actually gone up. 6 plus 5 plus 5. Now we're going to do this one more time. So C buys coin from B for 2 shares of stock. Now, A has 6 stock, B has 6 stock, and C has 3 stock and 2 coin. The coin, even though it's 1 coin, is now worth 2 shares. So the perceived wealth is now 17. Now the Grim Reaper arrives, and C decides, I need to send my kids to college. I got to sell some of my coin. So C decides to try to sell the 2 units of coin, but there's no one to buy it. So when C attempts to sell, there's a crash. And when there's a crash, the perceived wealth drops back to 15. And what we have is A has 6 shares of stock, B has 6 shares of stock, and C has 3. So the impact of the introduction of coin and all this trading is not a creation of wealth, but a transfer of wealth from C to A and B. It may continue to rise for an extended period of time, but ultimately it has no rights to underlying investment in goods and services, real things. So eventually, who's ever holding it won't be able to find someone willing to pay more, and the thing is likely to collapse. So I think this way of thinking about the financial markets is particularly important, to recognize that you get your return and they produce wealth for you because the cash is transferred to final investors who invest in real goods and services. A little tricky, but extremely important in my view. This has been Reflections on Investing with the Cornell Capital Group.